Mid-cap, small-cap and micro-cap with investors looking at portfolio returns swelling up. What's the way ahead for these categories with market hovering around all-time high? Do we see a trend reversal in the markets, or should you be booking your profit because before there could be a free fall in the market? Well, no one knows where the market turns, but having a hands-on approach on your portfolio can save a lot of trouble for an investor. So let's decode all of this. I have with me Sanjiv Bhasin, Director, IIFL Securities. Sanjiv, good evening and welcome to the Money Show. Thank you so much for taking time out and guiding our viewers on this. All right, so mid-cap, small-cap and micro-cap, this is what we're going to talk about today. And so when I planned the show, the run-up was unbeatable, okay, and suddenly the market turned, and in one day, we've seen a good amount of blood flowing out of these categories. But would you be calling it a trend reversal, or it's just too soon to say that?
Yeah, good evening, Kavita. Thanks for having me. No, I say that. Look, Kavita, the indices have been maybe range bound and you just broke out on the upside. But mid caps have been stellar in the last 4 to 6 months. And that is actually telling you that, you were missing the woods for the trees, because most people were tracking the Nifty between 18.5 and 19.5. But mid caps were doubling, tripling, and even going more than that. So it tells you that the sheer underweight and ownership pattern of a lot of the PSUs, particularly railway, defense, power, these have been, very, very unsettling sectors for the last 10 years. And lo and behold, in the last 1 year, they have been the most stellar wealth creator. The under ownership continues to be a sore spot. And, there are enough people who are calling it for a top and so on. They may be, when stocks go up 300%, if a 20% the downside happens, there will be alarm bells. But in no way can you change the future of these companies. These are now trending now for the next 3-5 years. And in the short run, yes, there is a little bit of froth, but I think it will be an evening out pattern. I still think there is room on the upside, and you have to be invested in these stocks. And if you have held them, Kavita, over the last 3-4 years, then only you are laughing your way to the bank.
All right, so there is upside room still left. But then, having said that, Sanjeev, what are the kind of valuation in terms of sectors that you see are very comfortable in this mid-cap, small-cap category specifically, where you see more upside?
So see, there will always be earnings to catch up. These were very, very good dividend plays by itself. I'll give you a brief, 7, 8 years, 10 years back, a Neyveli Lignite used to be at 11 rupees and it used to give 11% dividend. PFC REC gave 11-12% dividend just till, 2 years back at 90 rupees. Now suddenly those stocks are up three times or 5 times in the 7. And I'll just give you a brief. 3 years back, we suggested the CPSE ETF around 15 and 17 rupees. Today it is 53. So it tells you that there was a lot of value in these stocks, but they, flattered to deceive. They remained range bound. There was always pessimism. But lo and behold, suddenly the government's directive, the government's policies all have played out. And for once, the capex, the capex with the government, the private and the public both are deciding is going to be humongous. So irrespective of the short-term volatility where you can see maybe more, profit booking, the longer-term trend as far as defense, railway and power, all are very, very sweet. I'll just give a brief. DHBVN, where I stay in Gurgaon, is a government-owned power sector distributor. After 35 years, they're giving a different dividend of 6%, which tell you that we are power surplus, and from the 3 parts of power, that is generation, distribution, and the distribution losses have totally gone. So the lenders have been in a very sweet spot, and so have the distributors. And I think power and railways both are looking very good with the next 2 years, 3 years.
Okay, so these are the sectors and stocks that one can look at. But then specifically, let's just talk about microcap. And before we get into the nitty-gritties and much more detailed explanation about this category, do you really think it is healthy for an investor to be putting money in this microcap space, which is gaining too much of traction be it a trader or maybe even fund managers, with AMCs launching and microcap index. So there's a lot of frenzy going around with this particular category.
So, Kavita, first take it in a pinch of salt. In the last 4 months, mutual funds are unnecessarily had raised in excess cash, and they missed this rally. In fact, you see the NAV of most mutual funds, they have not even been able to beat the index, which tells you that the mid-cap frenzy is actually now a reaction, which is a late reaction, and them getting on the bandwagon. In the near term, there may be not that much of returns, but if you have a 3-5 year window, then some of these businesses can be tremendous. Look, I track stocks on market cap, and the market cap in the last 2 years was so abysmal that you could have bought anything and made money. Now, as the market realizes and the market caps get more, larger, you have to wait for earnings and the catalyst with that. But I still think that these three sectors, particularly railways, power, and defense, the guideline of the map which the government has is very, very strong. Plus, Make in India is a very, very strong theme, and anything to do with that is going to be a very, very big beneficiary. But like you said, if I again could recommend, I would say that the CPSE ETF, which comprises about 12 of these stocks, is a very good basket. So try and select a good mutual fund which has exposure, but do not try and be individually, too sharp. In fact, take a basket of stocks and try and make a portfolio. But like you rightly pointed out, Kavita, in the near term, there doesn't seem to be that much of an upside. But if you can enlarge your horizon, then you will be sitting on good businesses which can enlarge over the next 3 years as earnings and the capex start to mature.
Sanjeev, any word of caution for microcap specifically for investors looking, because these days the kind of questions I get on my show, people just have mid-cap, small cap, and even within that they really want to focus on building their portfolio in microcap. What would be your word of caution?
So my word of caution is don't get too carried away by the momentum. Momentum and feeling of missed outs are not too good. In fact, some of the large cap today, look, we made, despite the carnage yesterday on mid caps, today we hit an all-time high, and the bank nifty was roaring, which tells us that fresh money is going to go into large caps, and the large cap underperformance may be coming to an end. I would still say 50% must be in large caps at 20,000 plus, because the room for comfort over here is only in large caps, where earnings and the valuations are still reasonable. In mid caps, you will have to enlarge your horizon. And don't put whole hog money into mid or micro. Consult your RM, consult your business. IIFL Securities does this full time. Consult your RM, consult your mutual fund. Take some advice and try and balance your portfolio. Going whole hog at this time when indices have double, triple is very difficult. But like I said, it's a glass half full, half empty. There is a feeling of missed out, and people will latch on to any idea. So ideas are plenty when the market is bullish. Only when the tide turns do you realize, how many people have been left in the lurch. So caution definitely over here. Balance of portfolio is a must.
Large cap. Let's just focus our conversation on this now. According to you, comfortable valuations in which all sectors as far as large caps are concerned now?
So see, across the board, whether it's cement, whether it's banks, whether it's select autos are giving you an opportunity, or it's the telecom. I mean, Bharti hit a new all-time high, and so have the PSU banks. So PNB hit a new high, Bank of Baroda. So like I said, there is a lot of action in the large cap stocks, or large or semi-large cap stocks, which have a credential behind them where there is transparency of earnings, where the earnings trajectory seems to be good. And that is where you should be putting. I like some of the specialty chemical names. Just to name a few, as a disclosure, we have positions in these: SRF, Chemplast, Sanmar, Jubilant Ingrevia, Naveen Fluoro. These have been out of fashion because of a Chinese slowdown. But now with a lot of the specialty chemical prices coming back, you can add a Tata Chemical. These give you a very good risk reward, because as soon as the tide turns in maybe in China and other places, specialty chemicals will again be back in demand. So that is one neglected sector which you can start to look at. And I think real estate and construction will remain to be outperformers. So pick your winners over there, but be in slightly more higher market cap stocks where visibility will be better.
The next trigger for the markets, do you think, would be earning numbers now?
I didn't get that, Kavita. Could you repeat?
Sure, sure. So the next trigger for the market would be earning numbers now. That could give direction.
Look, firstly, let's see, we are in a bull market and we are at all-time highs. Secondly, the left-out feeling for even foreigners has been humongous. India's demographic premium is standing out, and we know till the elections or the budget, there seems to be no big negative. On the other hand, once we get a plateau on rates, I don't think the Fed is going to raise rates for a long time. And I think once the yields start to soften over there, and inflation, which is more or less now coming to 3.5%, that starts to even out over there, we could start to see a lot of action in emerging markets. The bane for emerging market has been rising yields, a stronger dollar, and higher inflation. All those three are now being priced in. I still think earnings, yes, will be the catalyst, but the sheer weight of the retail investor, I repeat, the retail investor is the wall behind this rally. And as long as the SIP continues, Kavita, you will have expensive valuations in India. And if you can choose your winners when sectorally, you're still going to make a lot of money.
So in this current scenario, it's also very important to understand how not to be in a very over-diversified situation in your portfolio. So how do you analyze if you are really over-diversified in a particular sector or in a particular market cap situation? Is it the time for you to maybe analyze things depending on your time horizon, or maybe the way you have allocated a particular market cap in your portfolio? How can one just look at it?
So three things stand out. First is your risk profile, your age profile, and third is your portfolio. Your risk profile tells you whether you want to be in those high beta plays which can generate faster returns, but can then equally be on the negative side. Second is, what is your age outlook? In the sense, are you risk averse, or you are closer to the age of 50 where you want to be balanced, maybe in a hybrid or maybe in some defensives or some bond portfolio. And if you are in the young age category, then new millennials are going to ride their way. You will not get businesses like Zomato or a Paytm or a PB fintech cheap. They will be expensive because the future belongs to them. And I think fintechs are the way forward. However, like we said, you have to rebalance your portfolio maybe on a quarterly or a month or a 6-monthly side. And that's where you need professional advice. So either consult your broker, your RM, or then diversify in the mutual fund which you own. But like I said, it is not a glass half full, half empty. Just being invested, Kavita, can be superlative, just like we've seen in the PSUs or the sectors which have outperformed, which did nothing for 10 years, but in 3 years they've done all what they had not done for 10 years. So just being invested sometimes in good businesses can be extremely rewarding but frustrating in the short term.
All right, so that's the word coming in from Sanjiv Bhasin. Thank you so much for being on the show and helping our viewers with their portfolio strategies today.